Hello traders, welcome back to my channel. In today's video we are going to be looking at a very important concept. I'll be teaching you guys my personal entry technique on how I use smart money concept combined with other blocks, right? So you guys will learn this high probability entry setups where I usually cash more than 1:5 trade risk to reward ratio in one single trade, guys. This is an example of the kind of trade setup that I'm going to be sharing with you guys, both for buy and sell scenario, guys. You guys will see how it is possible for you to be able to make a huge return. So I've been able to pass my challenges using this particular sniper entry strategy, guys. So you'll be able to learn how to take the strategy where you can use it in all markets, and then you'll be able to catch trading setups just like these ones that I caught, guys. So you want to watch this video till the end, and by the end of this video you should be able to pick a complete strategy, guys. I mean a complete strategy in which you can use and make profit in the financial market, guys. So make sure you pay attention right till the end, and make sure you watch the video till the end. If this is your first time coming across this channel, please make sure you give me a thumbs up. Make sure you subscribe to this channel by hitting on the subscribe button and notification bell so that I don't miss out. See you after the intro. Okay traders, welcome to my channel. I am Full Kingsley. By the grace of God, I bring to you guys strategies, tutorials on the forex market, volatility indices, metals like gold, Nasdaq, VIX75, many other instruments. You want to subscribe to the channel by hitting on the subscribe button and notification bell to not miss out. So basically, guys, this is the course outline right here. So we are talking about understanding what OBs, which is order blocks, supply and demand concept is, right? So it's just a concept based on how the the big movers of the market, how the institutions move the market, right? So we have the major supply that actually move price, and then we have demand that move price, right? So whenever you see very big moves in the market, know that the banks, what they call the hedge funds, the institutions that actually place trade. So we want to be taking advantage of the scenarios, right? So in a situation where we have a demand price, the institution actually place their buy trades and they wait to take the remaining buy trades, right? So supply is just the contrary. So we are basically looking at how we are going to combine top-down analysis with SMCs, right? So first of all, if you want to talk about demand and supply in the markets, guys, we have situations where price, the banks, we want to look at it in chart scenario, guys. All right. So in order to understand demand and supply, guys, we need to first of all understand what we call market structure, right? We need to understand the bias of the market. There are situations where price is either going down or going up, what we call, downtrend and uptrending market, right? So this is where the institution come in and then they actually take trades. And then also, if you can take advantage of this, you are going to make a lot from it. Now you see that price is creating series of lower lows and lower highs. This is what we call a downtrending market, and as a result of this, we have the suppliers that are taking control. And most times when price create a low like that, what happens is it leaves behind a supply zone, because if you see a very big move in the market like this, it means that the banks have actually executed parts of their trades. And what they usually do, they will execute 60% of their trades or 40 and wait for price to pull back to that zone so that they can be executing the remaining of their trades. And that is where we want to also be taking our trades, because they want to be selling at higher prices, right? While in a demand scenario, when price is creating series of higher highs, right, and creating higher lows, what happened? We want to be looking at those situations where the banks come in, right? Because in this situation, area where they started the movement from is where we call it the demand zone, because that is where they are going to actually pull price back to be taking the remaining entries. And that is where you and I will benefit and also take our entries, and we will be able to catch very massive moves, as I've explained in the concept, right? So basically that is the basics of understanding demand and supply, guys. All right, now looking at the chart scenario, guys, I'm going to explain the conditions in which we usually use to consider a valid demand and supply, right? So if you look at our charts, for instance, you are going to see this is a situation where price is creating series of higher highs and higher lows. What happened? We have a break of structure. Price create what? A high here. What happened? When price is pulling back now, this is the initial zone where the banks actually executed their trade. That's why you see these huge bodied candles. And what happened? We expect price to pull back to that zone for us to be entering. right? The contrary happens in a downward market situation. We see very huge bodied candles like this. We usually consider them to be the banks or the institution that have executed their trades. So we look for what break of structure, wait for price to pull back to those zones to enter. Right now, how you identify this is you look at the order block, right, or the demand, the build up that was formed before a strong move, right? We consider it to be our demand zone or the order block. Now the order block will be the candlestick that was formed before that strong candle, right? So if you look at it very well, you are going to see this candlestick has a difference, right? Because it has actually created a very strong bullish impulsive move. Now if you scroll left, you are going to see a similar scenario. This is a break of structure situation. Price create very strong bearish momentum, guys. This is a sign only the banks and the institution, the hedge funds can move price like this. Whenever they do this, what happened? We mark these candlesticks that were built before this move, right? Then we wait for price to come back to this zone to enter. But we don't just enter like that, guys. I'm going to share with you conditions that will permit us enter. So but you understand the concept. This becomes the order block or the supply zone in which we are waiting for price because they executed the initial. So the psychology behind this is that the banks actually, they don't enter all of their trade at once. So they take part of their trade, like 40%, right? When they take 40% or 60%, they have to pull back price to this zone, clear liquidity by manipulating many retail traders to enter trades, and then they stop them out so that they can have enough liquidity to take their remaining trades. So when that happens, price pull back to the zone, they are going to be able to take their remaining sell trades, and that's where you and I will benefit and take our own sell trades. And you see that most often price will drop. If you see situation like this, it happens, it leaves behind what we call a fair value gap. A fair value gap is simply the space between this big candlestick and the candlestick that was before and then the candlestick that was after. So it leaves this fair value gap, it leaves behind a supply zone. And what happened? We want to wait for price to pull back to this zone here, and then we sell, and then you see now that we are going to most probably catch that move. That is the simple concept, guys. But this is not, we are going advanced now, guys. We are going advanced. This is not the only thing we have to consider. I'm going to share with you the conditions to consider when taking taking a trade based on this concept. That's why I say we are going to show you how to combine top-down analysis, conditions to consider for value order block, and then how to actually enter or exit our trade. So we will be specific here. So like I said earlier, if you pay attention, you can adapt this strategy to be a complete strategy on its own, right? Now, if you look at a market structure like this, I'm using this particular market because I had very good winning trades this week using this. I made good percentages from it, right? If I go to a daily time frame like this is the daily time frame, isn't it? Now, what I try to look at, identify my key zones. Do we have any key support and resistance? Do we have any key demand and supply? I mean, because these are bigger time frame, guys. The bigger time frame zone actually control the smaller time frame. Now you can see that price has not been able to break through this zone for a very long time, right? Meaning that the probability of it just breaking now is actually little. So price can probably pull back from here. So when I understands that, what I do is I go further and mark all the other zones that are available, and then I understand from a bigger time frame perspective that okay, price is still moving within this range. It hasn't broken this zone yet. So what happened next? You should already know that the next probability is that price is most probably going to surge down, right? So when I've already established this from my bigger time frame perspective, which the D1 or the weekly, what I do now is I drop now to the H4 time frame, right? So when you go to the H4 time frame, what you're doing now is you are now looking for what? You are now looking for your market structure, right? You are looking at the market structure. What is the trend of the market? Now you see that price has rejected from a key zone there, and you see now that we have already rejection candlesticks that are showing, right? So basically at this point in time, we saw now that okay, price started dropping, right? Look at that strong bullish candlestick, or I mean strong bearish candlestick that shows that okay, there's a complete rejection from that zone there. So price dropped with very strong bearish momentum, right? So basically what I do is now I drop for that to my smaller time frame. Okay, I'm showing you how to use your your top-down analysis combined them with SMC to catch very good trading setups. We already have very strong bearish momentum here. Price has already changed character, right? So when they talk about change of character, it means that the high that was created, the previous higher low has been broken to the downside, right? And price has changed character. So at this point in time, we want to remember our concept of demand and supply, guys. We want to put that at the back of our mind, because that is how we are going to be using to actually be taking our entries, right? So at this point in time, price now builds up after that strong move below, right? Now you can already know that, okay, this is what this is already our order block there, because it is the candle that was formed before this strong bearish move, right? So in this situation, price can pull back there for us to be looking for setups, right? But now at this point in time, we have what? A breakout structure, right? Now, number one condition for you to consider why taking a sell trade is what we look for: our breakout structure. We want to ensure that price has broken structure, right? We have already established our trend that price is going down, because from a bigger time frame, price has rejected in a key zone. So basically, we want to wait for price to break structure, break below a zone like this, and then create a new low. That is number one condition. Number two condition is that we mark out what? Our order block, right? So we mark out our order block, which is actually the last candle that was formed before that strong move. Look at this strong move, guys, right? So which were the candles? These were the built up candles. That's where the banks were gathering their trades to take their first entries, right? That's the zone that we mark out. So we had break of structure, and then we are mark out our order block. Now what we are expecting now is for price to pull back to this zone here. But now we are not just expecting price to just pull back like that. What we want to see is, we want to see a liquidity grab. Liquidity grab is a simple scenario, right? A simple situation where price turns to clear out, people who are entering the trade earlier, right? There are people who are going to enter the trade earlier, maybe as price pulls back. If price creates equal highs like this, right? At this point in time, it means that the zone above here become a liquidity zone, because most traders are going to be what? Most retail traders who focus on small time frame are going to be selling at price pullback. So it will create a liquidity pool here in form of stop losses. So the bank will always want to allow price manipulate, consolidate like this, so that those people who sell here, they are going to stop all of their stop losses before driving price to their initial level where they will be selling now, placing the remaining orders. Because for someone to be selling, we need to have another person that have lost or who have bought. So if you lost here, it means you bought. So at this time, we want to look at this situation. We have two good entry techniques. Either price create a liquidity pool like this before getting to the zone, or price create a diagonal support or resistance. Now it could be in this form. Price could pull back like this, right? It could pull back like this, pull back like this, pull back like this, pull back like this, and once it taps to the zone, we sell. Now the concept behind this is, we are going to see liquidity below this zone here, because people will be buying, while above here we are going to see liquidity. So I'm just explaining the liquidity scenarios where you should consider, right? Because that is the only condition we'll consider before taking our trade. So we need a pullback like this, or the first pullback, because in this situation we basically have this zone here to be our liquidity zone. Okay, so we have our liquidity zone above there, and we have liquidity zone below here. So at this point in time, the people who are buying and selling here, they will need to stop them out somewhere. And at one point in time, when price taps to this zone, it needs to come back and tap, stop out all the people who are willing to be buying in this zone. So there's liquidity below this zone in form of stop losses, the liquidity above there. So in any case, there should be liquidity before price gets to this zone. That is the third condition, which is very important. We talked about identifying our order block, looking at the break of structure, looking at liquidity. So I've mentioned two methods. We are going to be considering more methods in the subsequent videos, right? But these are the very effective methods, guys. We don't want to just see price pull down straight and just go back straight like that with strong bullish momentum. No, when it's going on with strong bullish momentum, we don't buy, because the zone we don't sell because it can easily be violated. We need to see liquidity, because if it goes back straight, if it doesn't create a liquidity pool before this zone will be used as a liquidity pool, maybe going up before rejecting somewhere up there. That is what usually happens. All right, so basically that is what you should understand. Those are the conditions to trade these particular patterns, right? So basically that is it now. All right, so let's see what happened here. Okay, now if you look at this critically, you are going to see now that, okay, price actually consolidated, created its own liquidity here. If you look at it on a smaller time frame perspective, you see that we have a liquidity here. Look at, guys, look at these equal highs. Price consolidated for a while. We had a lot of people were selling, people were selling, people were selling here, right? So we had stop losses that were tapped here before price moved up that way. Okay, so now if we zoom a little bit, we are basically going to see that, okay, above here we have another liquidity zone there, right? So what we want to do now, oh, price, we actually played it fast. So what we were supposed to do already is to place our sell trade here. Okay, and then because of that rejection, our stop loss above that zone, we need to place our first target somewhere here and then our second target here, right? Basically that is it, guys. And then we wait for price to play out, and then that is how we make money, guys. We have more than 1:5 risk reward ratio. That is cut simple as that. I mean, it's very simple. Sometimes I can place a sell limit order as price is pulling up to this zone here, right? And sometimes, I'll place, wait for price to come and reject, and our sell limit order, we need to have our stop loss above the demand zone or above the zone. So basically that is it. So if you place your sell limit order 50% and then your stop loss above there, or place it at the beginning of the zone and a stop loss above there, you want to be targeting these zones there, and that is it, guys. So what happened now, we have another break of structure. This is what we call break of structure. Number one condition fulfilled again, right? So we have that break of structure there. Number two condition, guys, if I forgot to say this, we have what? Strong bearish move. Look at it, look at those type of candlesticks. That's number two conditions, right? We didn't mention this before, but this is number two. You need to look at this type of candlesticks, right, that are very bearish, because this is to show that the banks are in the move. We want to trade like the banks, right? So what next? We identify our order block here. This is the order block. Look at the candlestick that was formed before this bearish move here, and sometimes you can just extend it to be a complete demand zone. If you extend it to be a complete demand zone like that, by just looking at the complete candlesticks that were consolidating before that down move there, right, you can consider price to pull back to this zone here, and then we should be looking for our entries. Okay, you can see, can you see that build up, guys? Look at that build up, look at that build up, look at that build up. So this build up here, if you go to a smaller time frame, you are going to see a very massive build up here, which is creating a resistance above there. Price is not breaking through. This is to trade liquidity pool above that zone, which is one of our conditions, right? This is one of our conditions that we want to consider before we consider taking our trades, right? So basically we have that build up that has been formed. So we have liquidity above that zone that has to be cleared. We have liquidity below. So here and here. So we are expecting to be selling here, and then our stop loss, right? Our stop loss should be above the zone. Okay, our stop loss should be above the zone as we enter, right? So we enter, our stop loss should be above the zone, and then we have our targets below, right? So that we can play out and see how it works out. All right, you see what happened? We won the trade. So price actually pulled back a little bit, went up again, mitigated the upper zone, and then dropped, right? Basically, that's just the concept, guys. So what you have to do is continue doing the same thing. Now we have another break of structure. So we have another break of structure, guys. This is a gold mine strategy. You need to back test it, guys. Make sure you study. I've done a lot of back testing. Now this is another entry setup, right? See, this is liquidity here. This is liquidity that we have here, this liquidity that have been built here, right? We have equal highs that have been created, rejection like 4 times, guys. So we have liquidity above that zone there. We have our order block. This is the order block that was created before this strong bearish move here, right? Remember, we have our break of structure. This is where we had our break of structure, right? This is the last trade that I actually took, I think, right? This is a very good trade that I took, and I shared it in my Telegram channel as well. You can place your first target here, your second target here, right, as price tap. Like I usually place limit order. Sometimes I just place a sell limit order at the order block. Look at that build up that was formed before this move here, and then I execute my trade. As price move up, it executes my trade and drops, guys. That is where price is currently. This is the trades that I've been able to kill, and I'm sharing with you guys free. This is a complete strategy on its own. So you will want to watch this video, rewatch the video again and again, so that you understand the concept clearer, right? And then make sure you back test, guys. Back test, go back to your chart, scroll backwards, you replay. You make sure you replay. You can use go charting if you have not subscribed to this, if you have not subscribed to trading view, right? You can go to a site called gocharting.com where you can backtest for free. You can use the replay tool for free. You backtest, you look at other time frame, you replay, right? That is necessary for your success, guys. Backtest as many as 50 to 100 trades in different instruments, and then try now to take trades on your demo account. When you take trades now, you become used to the pattern, and then you see that you are going to make money in this market, right? Thank you so much for watching. If you found the video helpful, give me a thumbs up. Make sure you subscribe to the channel by hitting on the subscribe button and notification bell, guys, with other videos, or share with other traders. See you in the next video.